All right, we got another little rally on our hands. 30 minutes until the start of the cash trade. I'm Matt Miller.
And I'm Katie Greifeld. Bloomberg Open Interest starts right now.
A positive surprise on CPI. U.S. inflation comes in lighter than forecast for the third straight month. That data giving stocks a little bit of a boost this morning. And Goldman Sachs lifts its S&P 500 target, but remains cautious due to lingering uncertainty. Plus, we are live in Riyadh as the focus of President Trump's deal-making shifts to the Middle East. Katie, what stocks are you watching?
I have my eyes trained on UnitedHealth. It's plunging right now, down 10%. That's after it suspended its outlook for the year. The insurer is also naming board chairman Stephen Hemsley as its new CEO, replacing Andrew Whitty. Matt, this is another boomerang CEO. Yeah, very interesting story. We're going to dig deeper into that. We're also watching Coinbase jumping after S&P announced that the crypto exchange will replace Discover Financial in the S&P 500. So, Katie, a real changing of the guard. Let's get back to one of the big stories this morning, and that is CPI coming in cooler across the board, despite fears that inflation is headed higher amid the trade war. Now, before the data was released, Citadel founder Ken Griffin spoke to Sonali Basak about inflation in an episode of the upcoming series Bullish.
One of the reasons that Trump won the election was the American people had had enough inflation. They wanted a break from seeing their standard of living deteriorated by the ever-increasing price of goods and services. And so I really do think that the president needs to think long and hard about the necessity of helping to protect the standard of living of the American people by keeping the inflation, like, it's not a genie, it's like the inflation devil in the bottle.
Now, again, that was recorded before we got this morning's CPI report. So let's break it down now with Bloomberg's Mike McKee, who covers policy and economics for us. And Mike McKee, we didn't see much evidence of the inflation devil in this report, even though many expected us to.
Yeah, this is the not yet administration. Trump tariffs are supposed to cause a slowdown in growth, but not yet. They're supposed to increase inflation, but apparently not yet. CPI comes in lower than expected on a headline basis, up 0.2% for a 2.3% annual rate, which is the lowest since 2021, getting very close to the Fed's 2% target. The core also up 0.2%. Base effects keep that one at 2.8% on a year-over-year basis. But as Katie's talking about, under the hood, are there any signs of tariff push inflation? Not really. Household furnishings come from Southeast Asia, 0.2%, not much of a gain. Apparel costs down 0.2%. The wholesale rise we saw in used cars doesn't translate into consumer prices down 0.5%. Video and audio products, they were up 1%. Maybe that's the only canary we can find here. Airline fares, now this is an interesting one, down 2.8%, but this is because of tariffs and everything that's going on. Nobody wants to come to the United States. So apparently airline fares are down. And of course, the big number of the morning that the president is going to be touting, this is probably going to even be bigger than any kind of business deal he swings in Saudi Arabia. Egg prices down 12.7% in the month of April.
All right, Mike McKee, I'm looking forward to seeing that play through into the retail price that I pay at ShopRite. Mike McKee there, our international policy and economics correspondent. President Trump's first day in Saudi Arabia is already making headlines. The administration reaching a deal to grant Saudi more access to advanced semiconductors. This deal allows the government to buy chips from companies like NVIDIA and AMD, despite its ties to China. Bloomberg's Tyler Kendall joins us from Washington with more. Tyler?
Yeah, hey, Matt. Well, as you mentioned, this is still being finalized here, but we could expect the details of this deal to be announced as soon as this week, according to people familiar, as President Trump makes his way through the Middle East. The plan would give Saudi Arabia more access to these advanced semiconductors, but does come amid concerns from the Trump administration that the technology could fall into Beijing's hands. With that said, they are thinking about a few different provisions here that could potentially help to counteract that, including giving the U.S. government control access to data centers that ultimately use these chips. Of course, it comes against this broader backdrop of collaboration between the two countries when it comes to artificial intelligence and advanced technology, which really has been one of those areas where they've seen progress on, considering that the Trump administration has recently moved to rescind the Biden-era AI diffusion rule, which the kingdom had been lobbying them to do. Now, more broadly speaking, we could expect some other deals to come out of this. We know that President Trump is pushing for some pretty heavy investments from the kingdom. I actually was at the FII summit back in February. It was a Saudi-backed investment conference where President Trump first floated that he wanted to see $1 trillion worth of investment out of the kingdom into the U.S. Bloomberg Economics says that's a highly unlikely number to reach since Saudi Arabia has its own domestic policy goals that could counteract with that. But still, Matt, the kingdom had pledged when President Trump came into office that they would invest $600 billion into the United States over the next 4 years. That's a pretty hefty number. It accounts for about 55% of the country's GDP.
So perhaps we'll see more headlines like that one. But tell us a little bit more about what to expect from this trip. As you mentioned, it definitely seems like investments, securing investments are the goal rather than discussing some of those security issues, perhaps.
Right, exactly. And Saudi Arabia and the region at large has been sort of at the center of a few different policy priorities. You alluded to it there. Of course, the foreign policy front, Saudi Arabia has been key to the administration's push to try to reach an agreement, particularly when it comes to the Russia-Ukraine conflict. But really, we are expecting this to move away from foreign policy and really towards those investment goals as President Trump takes this tour in the backdrop of his tariff plan, trying to convince Americans, consumers and investors alike, that he's bringing in more investment to help boost his ultimate goal of domestic manufacturing. While President Trump is in Riyadh today, we are expecting him to shortly address the U.S.-Saudi investment conference. That's why we see a lot of big CEOs also there to greet him, including Elon Musk, Sam Altman, and NVIDIA's Jensen Huang.
All right, that is Bloomberg's Tyler Kendall in Washington on the latest on the Trump administration. Let's switch gears now and get back to UnitedHealth Group because shares absolutely plunging in the pre-market this morning. That's after surprising investors twice this morning. The insurance giant pulled its guidance for the year. It also named board chairman Stephen Hemsley back to the helm, replacing former CEO Andrew Whitty, effective immediately. Let's unpack this news now with Bloomberg's Cynthia Koons. She leads our U.S. health coverage. Cynthia, we'll get to the guidance poll. I want to talk about the change at the top, though, because it's interesting to see a boomerang CEO here, one that is 72 years old, really underscores the issues that this company is facing.
Yeah, it really shows some of the control he's had of the board and the influence he wields that he's stepping back into this position, and that's happening so abruptly. This caught, obviously, the market and investors off guard. It is maybe not surprising that Whitty was starting to run into trouble. The earnings outlook downgrade, which now has all been pulled, was a big disappointment, and they've had some downgrades in the past year and change, which is very unusual for United. They've been kind of a beat and raise, really steady Eddie growing stock for a long time. So the fact that he was in trouble doesn't seem to be a surprise to the market, but the fact that they made such an abrupt and quick switch in bringing the chairman into this permanent position was really surprising. And I think there's still a lot more for us to unpack here as we report this throughout the day.
So what has been, I mean, obviously there was the tragic murder of a unit head that got everyone's attention. But that is not what's driven the drop in the shares over the last month. I mean, they're off 40%, not even considering what we're looking at in the pre-market. What's the problem at UnitedHealth?
Yeah, there was a big reaction, obviously, from the public after that murder. It was obviously a tragic event the company had to reckon with. But what's really been pressuring them from a financial point of view has been Medicare. And they've been bringing in a lot of customers in Medicare, and they just haven't been pricing it correctly. And so these customers are needing more care. They're needing more medical treatments and services than the company has basically budgeted for. And so this is a persistent problem. It's not going away. They're trying to explain why that might be happening, but the explanations aren't keeping up. The numbers aren't keeping up. So the fact that they had to pull their guidance is just a glaring indictment of the fact that they couldn't pull that off.
Yeah, and that year-to-date chart really ugly. You saw that big drop in April. That's when they cut their guidance back in April. The shares fell 23% in a single day. So it's definitely been a really rocky couple of months for this company. We appreciate you staying on top of it. That is Cynthia Koons, who heads up U.S. health coverage here at Bloomberg News. Meanwhile, let's take a quick check on these futures. As Matt said, a really little rally in the S&P 500 right now. It was lower pre-market after that big day that we got yesterday, that CPI report helping to lift futures a little bit back into the the green, and we'll discuss the details next. This is Open Interest.
The U.S. CPI report coming in cooler than expected. The news sending futures higher ahead of the opening bell. Let's get reaction from UBS U.S. economist Abigail Watt. So, Abigail, we've kind of gone through some of the numbers here. It's interesting that, for example, Anna Wong from Bloomberg Economics said this should be the first snapshot of the effect the Trump tariffs from Liberation Day have on inflation, and it came in better than expected. Less inflation that Americans are going to have to face than maybe economists that we surveyed would have thought. Why is that? Why the positive surprise?
Yeah, so as you say, the inflation numbers this morning did come in better than expected. A 22 basis point rise in headline, 24 basis points in core. When we look at kind of the gap between our projections and what we saw in the print today, the bulk of the gap between our forecasts and what was realized was actually on the services side. I think we obviously saw softer kind of transportation services in particular in the print. So I think that was one element in terms of the downside surprise for us. But I think the important thing to note is that when we're looking for the impact of tariffs in the inflation data, we're looking at things like the core non-transportation goods. And when we looked at prices there, those rose 21 basis points. That was less than we had expected, but it's still the third highest rise in that component in the past 2 years. So I do think there are some initial signs potentially of some of the kind of tariff impacts in the data today.
So if you're looking for tariff-related impacts, and to be clear, that's what everyone is doing with these numbers, you can find it when you take a look at specific categories, like you mentioned, core non-transportation there. But when do we potentially start to see that ripple effect, basically to see it in more of these categories? Because it feels like investors are just on high alert for that.
Yeah, so I think there's a number of different reasons to think through the kind of potential lags here in terms of when we would see the tariffs potentially hitting the inflation data. When we look at the experience of, say, 2018, 2019, there tended to be a 2 to 3 month lag between the tariff announcements and then seeing some of the reaction in prices. I think the key thing to note is, there's a difference between kind of the tariffs being applied in terms of a formal announcement and then goods that are in transit. So there's still goods in transit that won't necessarily be covered by the kind of tranches of tariffs that we've seen in recent weeks. I think the other thing to note is that companies often have inventories, so you might not see as quick a pass through into prices with companies choosing to kind of rely on inventories rather than immediately passing on prices. And then I think the other thing to think about is just the kind of goods that are being tariffed. For example, if it's an input price, an input good rather than a kind of final demand good, then it could take a little bit longer for kind of some of that to show through into the inflation data.
I just want to mention that we're looking at President Trump. We've got live shots here of President Trump in Riyadh with Crown Prince Mohammed bin Salman. This is a signing ceremony. We told you at the top of the program about the economic partnership that the U.S. and Saudi Arabia have been discussing. Apparently, they're signing some contracts of that nature. President Trump hates memorandums of understanding, so that's definitely not what they are. But agreements of some sort, and we do expect to hear from the president on a panel with MBS shortly. We're going to bring you that live as soon as we get it. In terms of the kind of inflation that we're seeing here, Abigail, I mentioned Anna Wong from Bloomberg Economics. She said she expects to see a tick up in prices for core goods like cars, and certainly we've already seen a lot of that, and we're going to see more of it from companies like Ford raising prices to deal with tariffs and others. We're going to see, according to Anna, a jump in prices for clothing, for furniture, for household appliances, and housing costs, with the exception of the lowest tier of rents, are expected to go up. How do you see this affecting the American economy? Even if we avoid a recession, isn't that damaging?
Yeah, look, I think obviously our growth forecasts have been marked down relative to kind of a no tariff baseline. We do expect that this will feed into kind of slower growth in the US economy. And I think the key thing to think about is, as we were coming into this year, we were already expecting the US consumer to slow. We thought that the kind of delta that they would get in terms of improvement on inflation would be less than we had seen in kind of recent years. And this is actually going to offset, some of that positive delta that we were expecting to come. I think at the same time, our expectations are that the labor market will also continue to slow. So we have to think about the income side of the equation for consumers as well. I think the other thing to think about is whether, whether this leads to interest rates being elevated for slightly longer. And in that environment, how does that feed into kind of household balance sheets as well? If you've got kind of slowing real income growth at the same time as interest rates remaining a little bit higher for longer, it potentially puts a little bit more pressure on household balance sheets.
Well, Abigail, that's exactly where I wanted to go, because in the past 24 hours, it's interesting. You've had economists from all the big banks come out and push back their rate cut forecasts. JP Morgan, Goldman, Citi, all pushing back their forecasts for when the next Fed rate cut actually is. You take a look at this data this morning. How do you think this factors into Fed policy?
Yeah, look, I think if we think about the culmination of the changes that we've had, not just the inflation data today, the kind of news yesterday on the change in tariffs on China, I think that's one reason why the message from the FOMC last week was one of not being able to be preemptive in this environment. Obviously, I think with the changes in policy yesterday, the expectation would be that the inflation impulse from tariffs would be lower than we had previously estimated, clearly with the reduction in terms of tariffs on China. But there is obviously potential for kind of other tariffs to come into play. There's still ongoing Section 232 investigations that we're watching kind of closely to think about the potential for kind of sectoral tariffs as well. And I think it will continue to be something that is a kind of headwind to kind of inflation, to the economy and a contributor to inflation this year. So I think for the FOMC, this idea of the economy seems robust for now, and policy is kind of well positioned for where the economy is just now, but then needing to kind of just be kind of reactive rather than preemptive is kind of consistent with our expectations. So we actually have the next cut from the FOMC at the September meeting. So we have them on hold through the summer.
All right, Abigail Watt, thanks so much for joining us. She of UBS and U.S. Economics. Really appreciate your time. Hope we get back soon. I want to get back quickly to Riyadh here because we're looking at more signings, and if Trump signed an economic partnership between the U.S. and Saudi Arabia, the rest of these cabinet members are signing apparently memorandums of understanding. So Chris Wright signing one on energy, Pete Hegseth signing an MOU on defense, the U.S. and Saudi Arabia signing a memorandum of understanding on mining and minerals rights. So this looks to be really a longer and drawn-out signing ceremony. Katie, with an announcer, I guess, giving details to the audience of each MOU or framework agreement that's being signed.
Right. And as Tyler Kendall explained to us, we should expect a lot of these sorts of headlines and probably a lot more news when it comes to investments. That is why the Trump administration has traveled to Saudi Arabia. That is the goal here. And looks like we're just getting started. Look
at all the gold. President Trump has got to feel right at home with all of this gold and pomp and circumstance.
The man does like gold.
We're going to continue to cover this, bring you any headlines that cross, and of course, we're going to go back to Riyadh for the Saudi Arabian Economic Forum, where we will watch President Trump speaking with Crown Prince Mohammed bin Salman. The Open in 10 minutes. This is Bloomberg.
الإدارة الوطنية للملاحة الجوية والفضاء ناسا في الولايات المتحدة الأمريكية للتعاون.
Well, Goldman Sachs is lifting its 3-month target on the S&P 500 to 5,900, which is only a gain of less than 1% from current levels. Here's the reasoning, with David Kostin writing, already optimistic market pricing of the economic growth outlook, as well as uncertainty surrounding the magnitude of the impending slowdown in economic and earnings growth, will likely keep a ceiling on equity multiples during the next few months. Let's discuss now with Ron Temple. He is Chief Market Strategist over at Lazard. Ron, it's great to see you in person.
Great to be here. Thank you.
So that's the Goldman view, that maybe we stall out for the next 3 months, but 12 months from now, they see the S&P 500 at 6,500. So the direction of travel is higher with a lull. Does that trajectory seem reasonable to you?
Well, I agree with the volatility kind of muddling through for the next few months, but I'm less optimistic on a 12-month view. I think, it's easy to get excited by a lower than expected CPI print. By the way, you could attribute all of that lower than expected print to airfare and used car prices. But if we really zoom back out, I think April is likely to be a cyclical trough for inflation, with the tariff impact really coming through in the rest of the year. And I think we exit the year with CPI, core CPI, around 4%. I don't think the Fed is going to cut rates at all this year, which is obviously different from market expectations. And I think what people are missing here is you're going to have higher inflation, probably higher unemployment, and you're going to have growth. I don't think we get a recession, but I think you get U.S. economic growth that slows to a level below 1%. That's not a great environment for equities. They're already trading at 21, 22 times forward earnings on an earnings expectation that might be too optimistic.
Yeah, I mean, there are some people who don't expect the Fed to cut this year. There's some people, I was looking at Citi expects the Fed to cut from July through January, right? So 125 basis points. What does that mean for growth, the growth side of the Fed's mandate?
Yeah, I think the Fed's going to have a real challenge this year. Basically, you've got a dual mandate that for the last 3.5, 4 years, the Fed said price stability is a precondition for maximum employment. Now, that was a different environment. At that point, they were talking about unemployment at or below 4% in discussing price stability in that context where inflation was way above 2%. I think as we get toward the end of the year, we're going to have unemployment closer to 5 and inflation running closer to 4. And it's going to be a real quandary for the Fed. But given what they've said for the last 4 years, it's kind of hard for them to turn on a dime and say, well, now unemployment's more important.
Right.
If you get unemployment at 5.5, 6, then I think the balance shifts.
All right, so unemployment at 5%, inflation at 4% by year end. Hold that thought. We are just getting started here. Ron Temple of Lazard stays with us through the opening bell, and here is the setup as we head in. You can see the S&P 500. It's pretty much flat. We were down a little bit pre-market. Now we're a little bit higher. The Nasdaq 100.
Yesterday, we were up 3.25%.
We absolutely crushed it yesterday, so some of that enthusiasm coming back a little bit. Big tech higher, though, and the small caps, the Russell 2000, by 0.6%. The opening bell is up next. This is Open Interest.
We are moments away from the start of cash trade. This is Bloomberg Open Interest. I'm Matt Miller. You can see that we have a slight gain on the S&P futures. We had a 3.25% gain in the session yesterday, so massive rise on the S&P already in there. The Nasdaq futures up 0.25%, Russell 2000, the small caps up 0.5%. We hear the opening bells on the New York Stock Exchange. Fabrinet ringing the opening bells. FN the ticker, and they're celebrating 15 years of their listing on the New York Stock Exchange, in which the stock has climbed more than 2,000% to almost $8 billion in market cap. So some very happy folks there. Down on the NASDAQ, America on Tech is some sort of organization dealing with STEM and kids. Katie, in terms of the stocks to watch, I see UNH getting decimated today.
Absolutely. This is the biggest corporate story of today. That's UnitedHealth sinking in a big way after suspending its outlook for the year. The insurer also named board chairman Stephen Hemsley as its new CEO, replacing Andrew Whitty. So sort of a double whammy for investors there. Matt, like you said, more than decimated right now, down 11% on UnitedHealth.
And it's already had a rough month, down 40%. You were telling us earlier because they cut their forecast. Now they've pulled it, so losing basically half of their value in 4 weeks trade. Coinbase is jumping, going the other direction. This after Standard & Poor's announced it will replace Discover Financial in the S&P 500 benchmark index. So a real changing of the guard there from an old economy financial to a crypto exchange. I guess make of that what you will as Bitcoin trades at $100,000. Ron Temple of Lazard is still with us. And Ron, Sonali Basak, our co-anchor, has just interviewed Ken Griffin, and he was making a comment about the fact that maybe you would be better off having held cash from Liberation Day. It's antithetical to the way we're all kind of raised in this financial markets industry, right? You want to be always playing offense. You want to be always invested to some extent. But what do you make of that? This kind of volatility is difficult.
Yeah, it definitely causes some sleepless nights. And I think cash is an important role for every investor, but they have to determine how much is right for them, their individual situation. Having said that, over the long run, we do know that being invested in equities, whether it's public or private, is a better place to be than cash and delivers higher real returns. I also do think at current interest rate levels, you can argue for investment-grade credit, you can argue for other assets, but one thing that's interesting is year-to-date, the S&P is almost back to flat. But don't forget non-U.S. equities. I mean, the DAX is up 27% in U.S. dollar terms year-to-date. If you look at the CAC in France, up 15, the UK, FTSE 100 up 11. There's a world of opportunity outside the U.S., and I do think even though we're getting this reprieve rally right now because the tariff risk looks a little less bad than it was before, it's still a risk to the U.S. economy. And I think investors would be well suited to look beyond the U.S. and consider other equity markets.
Well, you think about some of those levels that you're talking about, a 27% rally when it comes to the DAX. Is that justified? I mean, if you had been doing so well in the DAX right now, would now be the time to take profit, or do you think that there's actually more room to run there?
And I should have been clear, that's in U.S. dollar terms. So about 10 percentage points of that is the dollar weakening against the euro. But I think your point is a great question. I look at the European markets and think this might be a watershed moment for Europe. What we've seen in the last few months, partly in response to the new administration in the U.S., but the German fiscal U-turn, I never thought we would see that, especially after we saw the election results.
I was really surprised.
I should have listened.
I mean, look, no. I was surprised as well. And this is one of those areas where a lot of people, even those who didn't vote for Donald Trump, say, you've got to give, to some extent, this guy some credit, right? These policies, even if you think that they're erratic, if you don't think they're based on solid economic theory, if you think they're volatile and wishy-washy, they still have brought about some pretty great results. Is the inflation number part of that? Is this still Biden's economy, or does Trump get to take credit for lower inflation, as he does so often on Truth Social?
I think it's a flawed assessment to try to kind of always ascribe a certain macro number to the current guy sitting in the White House, well, sadly, it's always been a guy, so I guess safe to say the guy.
Yeah.
But bottom line is, these numbers largely reflect the legacy, I would say, of Biden, plus some of the early influence of Trump. You're in that gray zone, but I think what's going to become clear, the reason I say don't get too excited about these numbers, is all of the importers in the U.S. who buy a lot of products from China knew that tariffs were coming on China. I think what surprised people was the tariffs on Canada and Mexico, right? We weren't expecting, by the way, to be fair, Trump did campaign saying he was going to put a 10% universal tariff in, and he did, so none of us should have been surprised. But my point is, importers front-loaded their orders. And so you haven't really seen the impact of those 30% plus tariff increases on China. That's going to come over time, and that would be clearly ascribed to the current administration because you can connect the dots from policy to reality that comes out of it. I think the challenge with today's inflation report, used car prices being down a little bit, I think used car prices are going to go up because of tariffs, as are new car prices. We already heard from Ford.
Right.
Airfares being down, you could argue that's a sign of weakening economy and people buying fewer plane tickets on a discretionary basis. So how do you allocate credit or blame? Hard to say.
Yeah, it seems like this is a not yet report, to steal a phrase from Mike McKee. I want to bring this conversation back to U.S. benchmarks because you mentioned the S&P 500 pretty much flat on the year from a pretty significant valley. What's not flat on the year, even though it's had a big bounce back, is the Russell 2000 in orange right there, still down about 6% or so for 2025. There's been a lot of false dawns for Europe. There's been just as many for small caps. Does this ever change?
I think there's opportunity in small caps. The problem is the thesis has been evolving over time. In my experience as an investor, an evolving thesis often means a broken thesis. But in the case of small cap, where I see the opportunity is not at the index level. I think there's a real opportunity in being active. You look at the Russell 2000, 40% of the companies lose money. You've got a lot of really low-quality companies, some of whom might someday end up being, 1,000% gainer because they make it to the next level. But many of them fall by the wayside and never make it. And so I think you really want to have more of a quality filter looking at the small cap universe. Maybe S&P 600 is a better metric because there are kind of profitability requirements in that index. But bottom line, I would engage it actively. And I do think some companies might be less susceptible to the trade issues. Some companies with better balance sheets might be less vulnerable to higher interest rates for longer. So it's really a security selection game there.
Yeah, I think it's fair to say that maybe index tracking is better for just larger cap companies, right? And when you're talking about these small caps that can so easily go bankrupt, that are so so reliant on financing, you've got to look at them company by company.
And there's a lot less sell-side coverage of these companies, too, so a lot more inefficiency. This has always been the argument for non-U.S. over U.S. in terms of being active. Emerging markets, small cap, in spades, because you don't have that coverage like you've got where you've got 50 analysts covering a mega cap tech company in the U.S.
Ron, great.
I gotta say, if you're a small cap manager actively with a strong stomach, this sounds like a lot of fun.
Yes.
Yeah.
Yeah, no, it does sound like a ton of fun. And obviously, because there's so many interesting companies that could go to the moon, right? But there are also a lot that could go bust.
Do the opposite of that.
Ron, really great having you here. Thank you so much for joining us. Ron Temple there of Lazard. We got to get you back very soon here. Katie, you're going to take a look at what's going on with stocks.
Yeah, let's take a look at the breakdown of this market because we're pretty much flat when it comes to the S&P 500. But then you take a look at the breadth. It's pretty much an even split. You do have 200 names, close 297 names in the green right now, 200 in the red. You can see that the ones who are leading the way or trying to push this benchmark higher, it's your big tech names, NVIDIA, Amazon, Meta, Broadcom, all trying to pull their weight here. You take a look at the downside, though. You have United, as you would expect, one of the biggest losers right now, especially from a points basis. Microsoft, Alphabet as well on the downside. And this is broadly what you're going to see if we take a look at the sector level as well. Pretty much an even split when it comes to what's gaining, what's losing. A little bit more in the green. You have consumer discretionary and big tech up top. And then you go down the list, utilities, staples, real estate, and healthcare. And let's actually click into healthcare right now, and you can see just how big of a weight UnitedHealth is. All the way at the bottom here, down about 11.6%. They pulled their guidance. They have a new CEO. They're bringing back the old CEO. And you can see that investors really shook by this news. Now, coming up, as we're talking about, that shakeup at UnitedHealth catches investors by surprise. We'll give you more details next. This is Open Interest. Welcome back to Open Interest. A check on stocks right now. You can see the S&P 500 pretty much at session highs, higher by 0.3%. That will probably be good enough to put us back in positive or at least unchanged territory for the year. And you can see big tech is doing a lot of pulling right now. The Nasdaq 100 up 0.6%. You do have NVIDIA rallying today. That's helping both of these benchmarks. It's not helping the Russell 2000, but still, you're looking at a gain of about 0.5% when it comes to the small caps. It's time now for our top calls. Some of the analyst action in focus this morning. And first up, Caterpillar getting upgraded to a buy over at Baird. That's thanks to its sales stabilization and the easing of tariffs. Next up, Chevron, though, getting downgraded over at HSBC on falling oil prices. The analyst is citing reduced upside for the shares, which are currently off by about 0.4%. And finally, Valero Energy getting upgraded to a buy at Goldman Sachs thanks to improved margins. Meanwhile, let's get back to one of our top stories, and that is UnitedHealth Group shares plunging this morning after a shakeup that caught investors by surprise. The insurance giant, it pulled its guidance for the year. It also returned board chairman Stephen Hemsley to the CEO role, replacing Andrew Whitty, effective immediately. Joining us now for more, I'm pleased to say we have Glen Losev. He is a healthcare analyst for Bloomberg Intelligence. And Glen, there's two pieces of news this morning. Obviously, they're connected here. Which do you think, though, is the bigger weight on shares? Is it the guidance pull or is it the CEO change?
I think the guidance pull is the biggest puzzle to the investors, especially after the company lowered already very cautious outlook after 1Q results, and now with this announcement today, it's incredible puzzling for investors regarding United and the overall overhang to the health insurance industry as a whole.
Is the problem that they're at this point being too generous with their payouts? Glenn, is this the issue, that they're not taking in enough in premiums and covering too much in terms of medical procedures?
Basically, yes. So United stated today on a conference call that the medical costs from the newly onboarded beneficiaries within their Medicare Advantage plans are much costlier than they anticipated. They also said that the bidding cycle for next year that sort of begins shortly will be enough time for them to recapture the margins next year. That being said, not enough information is available. And on top of that, this issue seems like it's reaccelerated relative to what they reported in 1Q. And also, United was probably the only outlier outside of the rest of health insurance companies that reported this surprising trends during the first quarter.
Well, Glenn, that's what I'm wondering. Of course, UnitedHealth is the largest seller of these health plans, but how do they stack up versus some of their peers when it comes to dealing with these issues?
So before the issues began, basically at the start of 2004 with the Change Healthcare cyber attack, the broader issues, United was the 800-pound gorilla and the best operators within the health insurance industry. Obviously, something went wrong over the last, over 12 months, and it seems like since the beginning of 2024, the company is on the back foot trying to fix things that are falling apart. That being said, obviously, United is United, and the opportunity to fix things is there, especially with the old current chairman and old former CEO taking the reins once again.
Glen, great to get some time with you. Thanks so much for joining us. Bloomberg Intelligence healthcare analyst Glen Losev. You can see his research on BIGO if you're using the terminal. Let's get a look now at some of the individual stock stories that we're following today with Bloomberg's cross-asset reporter, Isabelle Lee. Isabelle, what are you looking at?
We're looking at Coinbase. So the stock is finally going to be added to the S&P 500, which is a big deal. We have a lot of multiple proponents saying that this is a sign of times, really a sign that there's broader acceptance for digital assets. And we've got everyone from Michael Saylor to Cathie Wood really congratulating the CEO, Brian Armstrong. And Armstrong, for his part, made the point that this is a big deal because crypto is about to be in everyone's 401k. So shares are surging there, up by almost 15%. Up next is On. So On is raising its sales growth forecast to at least 28% in 2025. That's driven by strong demand despite the uncertainty. I know that some of the people here are fans of Hoka.
But indeed, you can name names.
One of the people here is a big fan of Hoka.
Indeed. Okay. But this company is backed by Roger Federer, and it's really become one of the top performers in the sneaker world. And it's expanded to tennis, to apparel, and everything. And it's been founded in 2010, but I feel like its rise really just began since the last few years. But still, it's really a big deal. Stifel called the results impressive. Truist said that they handily beat revenue. So good news for On. And last, we're looking at Rigetti. This is the opposite because we see shares going the opposite direction, down by as much as 10%. Rigetti tumbled after missing revenue expectations. Operating loss was also larger than forecast. It did report a profit, but that was really just an accounting gain. So the CEO said that revenue can be, quote, lumpy. He said that quantum computing really continues to be in R&D mode. And the company did notch a handful of contracts this year from the U.S. and the UK.
All right, Isabelle, great roundup as always. That is Bloomberg's Isabelle Lee. I do want to quickly take a look at shares of Hertz right now, down by about 20%. This is after the car rental company posted a larger than expected loss in the first quarter, pressured by a slowdown in consumer bookings. Revenue fell 13% in the period. You added together, shares down 18%. Certainly, this has been quite a volatile company to watch.
Yeah, absolutely. Big surge in the middle of April, and the expectation is that if we see inflation, it's going to drive up the value of the fleet that Hertz owns, right? That's also the problem with Hertz because they spent so much money buying Teslas that the value of their fleet plummeted. But now that we see less inflation, maybe that's not a great play. So Hertz today is going to be hurting.
Yeah, certainly. I will say Hertz through yesterday's close was higher by about 90% through the year. Obviously, a big chunk of that is coming out this morning. But coming up, the U.S. is set to boost Saudi Arabia's access to semiconductors. We'll take a look at the deal next. But before we get there, one lingering question hanging over U.S.-China tensions is whether Washington might broaden China's access to U.S. chips. Ken Griffin discussed this topic with Janali Bassick for an episode of her upcoming series, Bullish.
Does it serve the interests of the United States to reduce Chinese access to the most modern of semiconductors? That's a really interesting and ongoing debate. And I could frankly argue both sides of that debate. The key from my perspective, is consistency of policy is important. And in particular, we need to make it clear to our allies that whatever policy that we arrive at with respect to China does not define the way in which we will treat our allies.
Welcome back to Bloomberg Open Interest. I'm Matt Miller. Let's get a check on where stocks are just 22 minutes into the session. You can see the S&P 500 putting up solid gains. I mean, after 3.25% yesterday, we're up another third of 1% at 58.63. So getting back up towards those all-time highs of 6,000, 6,100 that we saw at the beginning of the year. The NASDAQ 100 also gaining 0.75%. So bigger gainers on the tech side. And that's really what we've seen. Mag 7 like powering this rally again. In terms of the individual movers, Coinbase is one of those gainers that represents, I think, a changing of the guard, right? They're in the S&P 500 now, or they're going to be, and they're going to replace an old economy company, Discover Financial. We just heard about Rigetti Computing from Isabelle. It's only a $3 billion company, but still worth pointing out it's getting absolutely decimated. So is UnitedHealth Group. In fact, more. It's down 14% after pulling its guidance and replacing its CEO with a former CEO. On Holding is like a shoe company. Boeing is like essentially a state-owned duopoly. And Nvidia up 3.25%. Now that's one of those big, heavy tech companies that really powers, Katie, this rally higher.
Absolutely. For more on the chip makers, we're joined by Bloomberg Technology co-host Caroline Hyde. We had a great Bloomberg scoop out this morning that the Trump administration preparing to announce a deal granting Saudi Arabia more access to advanced semiconductors. I have to think that's what's helping NVIDIA rise so much this morning.
NVIDIA, AMD as well. Both of those CEOs are in Saudi Arabia at the moment at the big conference that's happening at the same time as the president is there. And we are feeling that in but fewer hours, we could see this unveiling that Saudi Arabia will have more access to the most powerful chips. This is the undoing of the so-called AI diffusion rule, actually allowing allies to have access. Now, since 2023, you had to go and get a license if you wanted to sell into Saudi Arabia, into the UAE. Why? Because there's a worry that they were somehow managing to either redistribute those chips onto China or indeed allow China to access the compute via the cloud. So there are still some details to wield out here. Will we see that American data centers could be owned and controlled by America if they are indeed holding NVIDIA or AMD chips? Or indeed you have a so-called sort of data center embassy where instead of following local law in Saudi Arabia, they instead are dictated by perhaps America's laws. So there are some ways and means that they're going to be able to do this. But it's Saudi Arabia and also the UAE we're anticipating could be unveiled of being able to access these really sophisticated chips.
By the way, speaking of Saudi Arabia, I shouldn't be so flippant on Boeing. And Katie, part of your job is to say, Matt, don't be so flippant.
It's not a duopoly.
It's a publicly traded company in a very competitive environment.
Exactly.
And Saudi Arabia, of course, ordering 30 737s from Boeing, which is the reason that you see those gains. I want to ask you about another company completely, Caroline, and that is Google. You were talking, I think, yesterday about the fact that they may not be able to pay Apple $20 billion anymore. Well, they could turn around and use that money to fund a lawsuit they're facing in Europe. I think 12 billion euros on people that feel like they've been bilked.
Yeah, and civil lawsuits here that can really end up adding up. 12 billion euros, you have to put in the context of things, isn't a vast amount when you're comparing them to the quarterly revenue of a company like that.
Less than what they pay Apple annually.
But surprise, surprise, once again, it is the EU getting tough on some of these big tech companies. Remember, that comes in the context of tariffs, of the EU and US and combative relationship. And more broadly, Trump has not liked the way in which the EU has been forcing different laws upon some of the biggest technology and digital services offerers. So we'll have to see how that unfolds. But 12 billion euros for a civil suit, that could be significant.
All right, Caroline Hyde, thanks very much for that. Co-anchor of Bloomberg Technology. You can catch her program every day at 11 a.m. Coming up in the next hour, more on President Trump's trip to the Middle East, and we'll speak with Wendy Schiller of Brown. This is Open Interest. We are 30 minutes into the trading day. Welcome to Bloomberg Open Interest. I'm Matt Miller.
And I'm Shanali Basak.
President Trump and Crown Prince Mohammed bin Salman meeting with business leaders in Saudi Arabia. It's the first day of the Saudi Investment Forum, and both leaders are looking to secure deals for further business investment. We're awaiting comments by President Trump. Let's head to Riyadh right now, where we're joined by Joumanna Bercetche. And Joumanna, we're already getting headlines that the Saudis have committed to investing $600 billion in the U.S. What do we know?
Yeah, so actually, just to give you a little bit of context, we're standing in the plenary room where Crown Prince Mohammed bin Salman and President Trump are expected to show up any second now. You may see a group of people standing behind me on stage. Those are the business leaders that have today come to Saudi Arabia to sign some of those MOUs and agreements that will shortly be announced on stage. So lots of expectations about deal making as we've been previewing into today's meetings. But the headlines that are coming through do suggest that the numbers that will come through in terms of investment from Saudi Arabia into the U.S. will be quite substantial. We know in the past that the Saudi Crown Prince has promised to invest $600 billion over the next 4 years. Whether that number is up for discussion. But what we do understand is that a series of MOUs have also been signed on critical minerals, on energy, on defense as well. This $100 billion defense package has also been discussed, whereby Saudi Arabia would commit to be buying up to $100 billion worth of arms and weapons from the U.S. And then earlier on, you were just talking about the Trump administration decision to rescind those Biden diffusion rules when it comes to the exports of high-tech chips. And it seems that there is going to be an announcement on that front because many of these GCC nations do have very big AI ambitions in terms of how they want to build out their data centers, and they would require access to some of those high-tech chips. At this point, the details are thin on the ground, but it seems as though we're going to get an announcement of that sort as well. So lots of sectoral deals, MOUs still at this point. But as you can see behind me, there's a lot of buzz in anticipation of both the Crown Prince and President Trump showing up any second now.
Joumanna, it is a lot of money that is at play here. Of course, a lot of rules being changed as well. Let's take a very quick step back here and talk about big picture. The alliance between the two countries, as they grow, what does this mean for the economic future of both countries as well as a security alliance?
Yeah. You know, very valid point to bring that up, Shanali, because the first time President Trump made his visit in 2017, Saudi Arabia was just at the beginning of embarking on this Saudi 2030 vision. What is the Saudi 2030 vision? It's about diversifying, moving away from full dependency on hydrocarbon, oil, and encouraging other parts of the economy, which is part and parcel the reason why so many of these business leaders are here behind me today, because so many of those investment opportunities have opened up. But that also entails a lot of spending on the Saudi Arabian side. You hear about these big projects, these mega plans, NEOM and the like. Trillions of dollars are spent in anticipation, of course, of the other big events like Expo and World Cup that are expected to come. So huge spending outlays. At the same time, we talk about oil. The price of oil has been dropping. OPEC Plus have been reducing their supply. So the revenues that are coming in to Saudi Arabia are less than before. That puts them in less of a position to dish out spending abroad than they were, say, 8 years ago, the last time President Trump was here. So from the Saudis' perspective, they also want to ensure that they're not just signing MOUs to send money abroad, but that they also want to bring money in. And it was interesting earlier today, BlackRock CEO Larry Fink was on a panel, and he was saying in the past, Saudi Arabia was perceived to be an exporter of capital. But that's changing because many of these industry leaders are sensing opportunities in real estate and infrastructure, transportation, and in these other non-oil parts of the economy that are growing very fast here.
Well, that's something we learned watching your program, Joumanna. Great having you on Open Interest. Thanks very much for joining us. Joumanna Bercetche there in Riyadh. Let's get to that CPI surprise now. Back here in America, Wall Street reacted positively to the data, showing really limited inflationary pressures from the trade war. In fact, I think it was the softest figure that we've seen year over year since the middle of COVID. Let's take a closer look at this morning's data with Bloomberg's Michael McKee, our international policy and economics editor. Mike, what do you see?
Well, since 2021, so before the inflation.
To me, that's the middle of COVID, right? 2020 to 2022. So smack in the
Somewhere
middle was the
smack
last
in the
time we
middle,
saw.
yeah. But we didn't have the big inflation yet, and we don't have it now, just 0.2% rise. The real question out of this report, though, was what does it mean in terms of the president's tariffs? Are we seeing any indication that his import taxes are pushing up prices? And we're only getting a little bit of an intimation. Household furnishings were up a little bit, but look at apparel, down 0.2%. That's one you'd think would go up. Used cars were down 0.5%. Big rise in wholesale prices, but not at the retail level. Video and audio products, that's where we see the first indications, up 1%. But look at airline fares. This is kind of an interesting one because it goes against the grain. It's because people don't like the tariffs and the United States right now. They're not coming here, so airline fares fall. It's not a sign that tariffs are not having an impact. Maybe it is a sign they are having more of an impact. And, of course, this all just leaves us with the question of what's the Fed going to do? Absolutely nothing at this point, but the markets have pushed back now to September, the first rate cut.
Can I just jump in and say, so I follow the used car story, both at the wholesale level, I watch the Manheim auctions, where prices have just soared, and at the retail level, I'm always on Auto Trader, and I just haven't seen it come through yet. I don't know why.
We're going to have to bring the Manheim Index up more for you in the next couple of weeks, because I agree with you. But listen, on the point about rate cuts, what I think is interesting is, okay, inflation has not gotten out of control despite the tariffs, and you don't see much of an impact in the bond market. In fact, because I wasn't here yesterday, I'm just going to sound the alarm that the 10-year is closer to 4.5%. You actually see the 10-year yield up after the data this morning still. You also see the 2-year down a little bit, but not erasing very much of that almost 12 basis point gain yesterday.
Well, the 2 is going to be pegged to the Fed, and nobody's expecting the Fed to do anything. But I think what you're seeing at the long end of the curve is a reaction not to CPI, but to the budget debate up on Capitol Hill. They're talking about a lot of spending, a lot of additional tax cuts coming in 2026, 27, 28. So you've got a fiscal pipeline out there of additional money for at least the well-off to spend. And that may be what they're worried about, that we're going to get more inflation out of that.
I think it's sugar for the bond market. Oh, sorry, sugar for the stock market, molasses for the bond market.
Oh, that's sweeter.
It's sticky.
Sweeter.
This is an
sticky.
old
I got
saying
it.
or something like that.
I'm waiting to see really the banks come out and change their forecasts a lot.
Well, we are seeing that this morning. We're seeing Goldman, we're seeing Deutsche and Barclays, and especially J.P. Morgan pulling back. J.P. Morgan now sees a rate cut this year. They hadn't before, starting in December. They're the latest, but we are seeing people say maybe we get a little bit more inflation.
I just know that Citi had expected cuts at every meeting from July until January. So 125 basis points of cuts, and that seems maybe a little overdone in light of the data that we saw.
Well,
today.
especially because nobody's at this point expecting the economy to roll over immediately, and most people have dialed back their recession calls because of the reduction in tariffs. Not that we're not going to have tariffs that will generate inflation and will slow growth, but not enough to get us into recession is basically the new view on Wall Street.
Torsten's Lockett Apollo brought his odds down to 30%, and he had previously said 60% for the odds of a voluntary trade reset recession.
I'm the annoying woman on the desk that's saying, okay, inflation is not a problem today, but if you're getting that much fiscal sweetener, I wonder if it's going to be a problem tomorrow.
If it's sweetener. We can talk about salt taxes, and we will. Mike, thanks so much for joining us. Mike McKee there talking to us about the inflation numbers. Let's get a look at some single stock stories at this hour. UnitedHealth is one of the big losers today, naming Stephen Hemsley as its CEO because it had to replace Andrew Whitty, leaving reportedly for personal reasons. But the insurer had reduced its guidance, leading to a 40% drop in the stock this month. Now it's suspended its 2025 outlook, and you see the shares are down another 14%.
I'm also looking at Coinbase here, up more than 15% now. That is really the only biggest jump you saw since early April. But you're looking at a $61 billion company now on the brink of entering the S&P 500. A lot of people are excited about it. It's replacing Discover Financial. So maybe that tells you a little bit about where the future of finance is going.
No, I think that's so interesting. My first corporate card here at Bloomberg 25 years ago was a Discover card. So this is, to me, like representative of the old economy.
Yeah.
And now you've got it being replaced by Coinbase. I'm not sure how bright the future is.
You know, stablecoin fees can be zero for payments. sometimes. And on Coinbase, they are. So we'll see where that goes.
All right. Hertz shares also falling after the company you saw in the red, reporting a larger than expected loss in the first quarter, driven by a slowdown in customer bookings and a 13% revenue decline. All of that is bad. But I would say that lower inflation for used cars also bad for Hertz, right? Because it maintains this massive fleet and it has to sell those cars on later. And if you're not seeing higher used car prices, it hurts.
But let's see if the Bill Ackman story plays out, right? Who's buying the dip on this one? We'll see. To your point, it's a long road ahead. Anyway, still ahead, Ken Griffin. He praises the Trump administration for progress on U.S.-China trade, but he notes that there are still more negotiations to come.
To see the U.S. Secretary of Treasury come to a meeting of the minds with the Chinese leadership was an important moment between our two nations. And I'd like to take this not as a moment in time or reflect upon the fragility of what's been accomplished, but rather to focus on the fact that we have opened the doors to a negotiation. And I do believe that the actions of both parties makes it clear that we want to find common ground.
Let's get now to high interest and look what's making headlines around the world. The Trump administration is cutting another $450 million in grants to Harvard. That figure is in addition to the $2.2 billion it terminated last week. Trump's task force to combat anti-Semitism says the college has failed to confront the pervasive race discrimination and anti-Semitic harassment plaguing its campus. Harvard, for its part, is rejecting the allegations that the school has a political bias. In a surprise move, UnitedHealth named board chairman Stephen Hemsley as its new CEO, replacing Andrew Whitty, who stepped down reportedly for personal reasons. Hemsley had previously served as the company's CEO from 2006 to 2017. The insurer is also suspending its 2025 outlook because of higher than expected Medicare costs. UnitedHealth has faced a turbulent run since the December murder of its top executive. The company is facing harsh criticism on social media from people fed up with the U.S. healthcare system. And the diamond giant De Beers has been quietly selling rough diamonds at sharply marked down prices to a small handful of customers. It's a highly unusual move that's fueling tensions across the industry already mired in crisis. The secret deals appear aimed at reducing De Beers' ballooning inventories without openly cutting prices. Shonali?
And Matt, I just want to mention here that with the rise in the S&P 500 of about 0.7% on the day, we are on track to erase declines for 2025. How much have we come so full circle here? We are still looking at a NASDAQ 100 that is even seeing even bigger gains on the day here. So a lot of exuberance still in the market. But as we've been talking about, not so much in the bond market where the fiscal concerns still reign. Now we're going to go to Miami, where I caught up with Ken Griffin. The Citadel founder reflected on recent market volatility in an interview for my upcoming series for Bloomberg Originals, Bullish.
Ultimately, any effort to force manufacturing back onshore into the United States is going to be inflationary. There's no doubt about it. And what frustrates me on this is that one of the reasons that Trump won the election was the American people had enough inflation. They wanted a break from seeing their standard of living deteriorated by the ever-increasing price of goods and services. And so I really do think that the president needs to think long and hard about the necessity of helping to protect the standard of living of the American people by keeping the inflation, like, it's not a genie, it's like the inflation devil in the bottle.
So what does this mean for Fed Chair Powell? How difficult does this dynamic make his job? And do you think his job is secure through May of 2026?
I got to tell you, I'm really happy not to have his job. Like, he is the biggest no-win job in the country. Because through the lens of hindsight, we will always be able to second-guess every single decision he makes. Right here, right now, he's grappling with, do you cut rates as the labor market shows ever so slightly signs of softening? Or do you hold the course because of the risk of an inflationary spike coming from tariff increases? He's going to have to make that decision based upon evolving policies over the weeks ahead. It's a really tough predicament he's in right here, right now.
Ken, it sounds like you have doubts that the American economy can be easily transitioned into a manufacturing one. What are the chances of making that work? And do you think that it's a realistic goal?
I mean, look, there's a great video clip from Dave Chappelle, and it goes something like, Americans want to wear Nikes, not make Nikes. And I think he's spot on. I don't understand why we think it's a virtue to bring back to America low-skilled jobs in manufacturing. I completely agree with the president. We need the ability to ramp up our manufacturing base to strengthen our national defense. Spot on right. But I don't think the American people are looking for a return to low-skill, low-paying manufacturing jobs in our country. I don't think they want those jobs. I think they want jobs where we are building high value-added products, successful businesses building high value-added products where you can create jobs in that factory floor that are well-paying jobs. Those are the jobs we should aspire to create in our country, not jobs that right now China is actually trying to move to other, even lower-cost labor countries. Why do we want those jobs here in America?
I'd love to see this from your position leading Citadel and also your message to Citadel Securities employees. What do you tell them to navigate all of this volatility?
So I will tell you that for my portfolio managers, it has been several really challenging weeks because every couple of days there's another big headline on Bloomberg that we need to react to and we need to reshape our portfolios with respect to. It's been a really difficult time for fundamental investors because so much of the value of the companies that we invest in is being dictated by very quickly changing policies from Washington.
So your best way to navigate that?
I think in retrospect, perhaps holding cash would have been the best way to navigate this, but that's so contrary to our culture of always trying to be on the offense, always trying to find ways to create value in the markets.
Is there something fundamental that's changing about the way you approach markets?
Look, I fundamentally believe that this period of instability that we're going through will come and go. Like fundamentally, I believe that as the Trump administration moves through time, as policies become solidified, the economic backdrop against which one invests capital will become easier once again.
And that was Citadel founder Ken Griffin. You can check out the full interview in my upcoming series for Bloomberg Originals, Bullish. And it's interesting because I've got to say, Matt, so interesting. He's the second billionaire in a week. Mark Rowan had the same response. I'm glad the Fed's job is not my job. They're in a tough spot. We'll see where this goes. There's worries about inflation, but maybe less worries about a fall off after the tariff escalation.
Yeah.
Certainly the markets are showing for it.
Yeah, no, absolutely. Of course, Jay Powell has a really difficult job. What I took from this that I found so interesting is that he said he would have liked to be in cash. And I've been thinking about this ever since Liberation Day. I mean, so many people that we speak to say, no, that's not the way to go. We want to be fully invested. We always want to be playing offense. We want to be in this market. You got to be in it to win it, right? But that's just the mantra of the financial industry. Obviously, they want everyone to be fully invested. The idea that you have to be all the time just doesn't really make any sense logically. And sometimes you want to sit out this kind of volatility.
And it's incredible. It's an incredible thing to hear from a hedge fund manager where, of course, you're paying them to be invested, not to be in cash. So it's an amazing moment to say, OK, well, wait a minute, maybe sitting some out, to your point, is a good one. What I wonder is, are the people going to sit this out in the bond market? I'm stunned by the moves over the last couple of days. And I really think, and we'll talk about it more in the show, the fiscal is going to start taking more front and center.
Yeah, well, we were talking yesterday with Peter Atwater, the economist and professor at William & Mary, and he was saying, you know, it feels like the stock market is fairly passive, even though volatile right now in terms of passing judgment on policy, and the bond market will not be. That's where the bond vigilantes show up. Let's get a quick check on what's going on in stocks. As Shanali pointed out a few minutes ago, we do have a rally here on the S&P that's going to push the benchmark index back up into positive territory for the year. So we've come full circle in terms of a drawdown and then a rise back to gains 58.88. That's got to be good luck in some culture. The NASDAQ also getting back into a bull market, up 1.25% right now as NVIDIA rises higher. I will say the Dow Jones Industrial Average, if you watch that like me, is still negative for the year. This is Open Interest. Take a look here at the move screen. This is really the most dynamic way to look at the S&P in one snapshot. It gives you the breadth. We have 319 companies up, only 179 companies down. NVIDIA really leading the way, as it always does if you organize it by points. UnitedHealth taking the most away, falling 14% after replacing their CEO and pulling their guidance. In terms of the sectors moving today on the S&P 500, you see consumer discretionary as well as IT and industrials leading the way. On the downside with UNH, obviously healthcare, the biggest loser, but real estate and staples, those defensive sectors also losing. Still ahead, President Trump is in Saudi Arabia on his first scheduled overseas trip since taking office. We'll talk about it with Wendy Schiller of Brown University next. This is Bloomberg.
Now, President Trump and Crown Prince Mohammed bin Salman are meeting with business leaders in Saudi Arabia. The U.S. says Trump has secured $600 billion in investment commitments, with agreements to boost defense and technology ties. Trump will be speaking shortly from that investment forum, and we're going to head to Riyadh, where we are joined by Bloomberg's Joumanna Bercetche. $600 billion. This is on top of money or in addition to money that has already been put aside. How do you think about this in the context of the alliance between the new nations, especially after the Stargate announcement earlier on in the administration?
Well, we always knew that this trip was going to be about deal making, and now just in the last half an hour, we're getting a little bit of a contours around some of the numbers that are coming through. So that 600 billion figure is a headline figure, but I should also just note that that is the same number that was discussed when President Trump had that phone call with Crown Prince MBS back in January, shortly after his inauguration. At the time, President Trump did say that the Saudis had committed to investing $600 billion into the U.S. over the next 4 years. That seems to be the figure that they've agreed to today as well. They will be arriving in this very hall, we hear, in the next 10 to 15 minutes after that signing ceremony, where the White House afterwards said that the Saudis had agreed to that figure. But we're also getting more detail on some of the other MOUs that have been signed. Let me just run you through them. Quite significant MOUs on energy, mineral resources. Also, Saudi Arabia have committed to buy a total amount of $4.8 billion of Boeing 737-8 aircraft. That's from an airline leasing company in Saudi Arabia. And then they've also agreed to some partnerships in the healthcare space, about $5.8 billion of commitments coming through there. And then also Aramco, the state-owned oil company, earlier in a panel said that they were looking to spend $3.4 billion to expand their refinery in the U.S. as well. So we're piecing together all of the deals and investments that are coming through. But that headline figure, $600 billion, is the one that the White House released a short while ago. And in a moment, when the Crown Prince and President Trump show up, they will be giving some remarks, and we should be hearing a little bit more about what the contents of these investment commitments might entail. One other factor as well that we should also take into consideration is artificial intelligence and cooperation on that front, because in the run-up to this visit, we had talked about the Trump administration repealing some of those diffusion rules put in place by the Biden administration that would allow for GCC countries, and not just Saudi Arabia, to get access to some of those high-tech chips that they've been looking to get access to expand their own AI ambition.
Well, and those high-tech chips, obviously they can be used for AI. They can also be used for military purposes. The Saudis want more access to weaponry as well, and I believe they've had a defense agreement. How does the U.S. square that circle, giving access to the Saudis these things when the Saudis themselves have a fairly close relationship with China?
Yeah. So right now, we don't have a lot of details about what exactly the agreement entails, but I think it was interesting because earlier, right here in this plenary, we heard from David Sachs, who is AI and crypto czar, and he was saying that their reason to abandon the diffusion rules is because they sensed that they were too bureaucratic, but that you can still maintain control over chip access, but do it in a less bureaucratic manner so that the U.S. don't lose the AI dominance that they currently have. And so that's where the decision-making came from. I think when it comes to the details, they'll probably have to institute some guardrails around how many chips can be sold, or possibly one idea that's being discussed is for the U.S. to maintain some access to the data centers that will be operated in Saudi Arabia using some of those high-tech chips that will be bought under these new conditions. But on the back of that, and you were talking about it earlier in the show, it has been a boost to some of those chip makers, NVIDIA, AMD. I should also just say on the defense front, since you brought it up, the White House also just spoke about the largest defense deal that I think has been signed in history, those lines just coming through in the last 15 minutes, whereby Saudi Arabia have pledged to buy up to $140 billion worth of arms and weaponry from the U.S. as well. So significant defense deal coming through. And that is something that Saudi Arabia, the Crown Prince, has been pushing for as well.
All right, Joumanna, thanks very much. Bloomberg Horizons Middle East and Africa anchor Joumanna Bercetche there in Riyadh. Let's take a deeper dive now into President Trump's Middle East trip. Wendy, Schiller, director of the Taubman Center for American Politics and Policy at Brown University, joins us. And Wendy, I think it's significant that this is really his first foreign trip. Okay, he went to the Vatican for the funeral of the Pope, but this is the first, scheduled diplomatic trip that he's made. How important is the Saudi relationship to the U.S.?
Well, the Saudi relationship has always been important to lots of presidents. It's not just Trump. But this is Trump-like in the sense that this is about deal-making. This is about going, and it's not necessarily about diplomatic relations, although he can certainly conduct those while he's there. It's about deal-making and showing how the United States wants to partner with countries where it will advantage the United States. Trump doesn't see it as worth his time to go on any of these sort of international or foreign trips if he can't come back with a win or a victory. And it sounds as if he's got multiple wins and victories that he wants to tell the American people about from this trip.
Wendy, I'd love for you to comment directly on the defense sales, because this value is at $142 billion. It's a very, very significant deal on top of other types of economic allegiances, for example, in pursuit of greater build out of AI capabilities. What do you make of the defense sales in particular?
Well, the Trump administration doesn't really have, as yet, a coherent policy on defense. They want to cut some personnel. They want to cut defense spending. At least that's what the Secretary of Defense has been saying. At the same time, we produce so much armaments. This is what we've been sending to Ukraine, for example. And we have faced some shortages, as a matter of fact. And so in that sense, it's like, are we going to be the weapons supplier for the world? And what does that do to our own capabilities in terms of giving or lending? You can't lend weapons, they get used. But in supporting foreign nations in foreign conflict, Trump doesn't want to do that much anymore, but he's not walking away from Ukraine yet. So I think this is complicated. We've always sold to Egypt, to the Saudis, to the Israelis. We've always done that. The question is, what's the balance between what we're doing for ourselves and what we're spending domestically and what we're making off of these deals?
I want to remind everyone that it's not just the Saudi relationship with China that could be troubling, but let's not forget the Saudis had the journalist Jamal Khashoggi killed in a horrendous way. Their record on human rights is not a good one. Does that matter anymore to any of these administrations? I'm not saying Trump specifically, right? President Biden also gave MBS a fist bump.
I think the situation in the Middle East in particular is still very precarious, and the idea of terrorism homegrown terrorism, harboring terrorism, obviously Al-Qaeda and its roots in Saudi Arabia, and thinking about getting as many allies in that region to still work on the global war on terror. And I think that's one of the reasons that Democratic and Republican presidents have maintained relationships with some people and some rulers who have policies that I think would be anathema and totally objectionable to the American people. But on the other hand, you've got to have a network where you have allies, where you have a really tumultuous region with multiple terrorist groups that have made it their mission to attack or harm the United States.
Wendy, it's interesting because this has been a positive week for the markets, at least the stock market, when you saw the deals that have been cut over the prior days when it comes to tariffs. But I want to now move on to the tax bill, because when you look at what's in here, I'm actually most wondering how you think that this is going to play into the midterm elections. You already see the bond market really speaking with its feet, but do you think Americans by and large will be happy with what they see being put down?
Well, Sonali, this actually is intertwined with cuts to domestic social programs. So, you can do a lot of things on the tax front, but if middle class or suburban or upper middle class taxpayers have to foot the bill for more Medicaid costs, for example, for even things like making up for holes in food stamps, if those get cut, you're going to be, yes, getting a tax cut, but then the local county, city, and state governments will have to raise taxes to pay the bills that they need to pay to cover the losses in federal social welfare programs. So taxpayers have to pay attention. They're making money, maybe having more in their pocket, but are they going to have to pay for it at the local level? And that's something that the Republicans don't seem too concerned about, except for Medicaid and Republican governors. We've seen a big shift in the last 2 or 3 weeks in the Republican caucus in the House on how far they'll go on Medicaid. They've really rolled it back in terms of what they're willing to cut. And that shows you they are aware of this balance between the cutting of the taxes and then potential increases in spending for taxpayers at the local level.
Wendy, I want to ask you about SALT. I see those books behind you, Inequality Across State Lines. I know that's about victims of domestic violence and not about state versus state or state versus federal issues. You have electing the Senate there, which is about, I think, pre-17th Amendment representative democracy. But it makes me think of these issues of SALT. It was in place, the deduction, for 104 years. It was a way for people to control local budgets without having to give all of their money to the federal government, and an equalizer in terms of the cost of where you live, and also double taxation. What do you think about the history of SALT that President Trump essentially canceled in 2017 and we're going to fight about now with this new one big beautiful bill?
Well, Matt, I mean, some people would argue that this is retribution against blue states, which tend to be much higher tax states, and so people benefit from SALT or need SALT more there. I don't buy that. I think it's broader. The Republican Party wants to reduce the role and spending of government in people's lives, and that means social welfare spending. It means spending on education. It's spending all the things that they're cutting at the federal level. They want to cut at the local level, too. They believe in smaller government. And if you starve these states that have more generous programs in those areas, because people, can't buy houses, aren't selling houses, can't afford the taxes, don't want to pay the mortgages, all those sorts of things, then you will reduce spending. There won't be enough money to support the kinds of programs that Republicans ideologically believe should not exist. So this is a much longer, more calculated strategy than just punishing. This is about, reducing the footprint of government. And so you can say, well, it's helpful in all these ways, but if you don't believe the government should have a role in those areas, or a significant role, then you think it's harmful because it sustains spending in areas the Republicans want to cut.
Wendy, we thank you for your time this morning. A lot going on in Washington, of course, now also around the world. That is Wendy Schiller of Brown University. Let's get a check on these markets because we're looking at green territory on the year. It's not even June. We're not even halfway through the year, and we are back in the green. You're looking at S&P 500 up about 0.6%. Inflation under control for now, given all the tariff rhetoric. The NASDAQ 100, Matt, just flying.
Yeah, absolutely. Back into bull market territory. There are some who expected the market to gain throughout this year, not to take a huge dip and then have to recover from that. And we are hearing from strategists, Goldman Sachs, for example, David Kostin, who say that we're going to go higher. I think their 12-month target is now 6,500. But yeah, we're back to where we started essentially this year at 58.80, and The question is, do we continue to get these low inflation prints that would allow the Fed to cut, right, and support the economy? Or does inflation come bouncing back, like our 9 o'clock guest said, and hold the Fed back from making those cuts?
You know, Ken Griffin yesterday told me that I'm too pessimistic as a New Yorker. Those Floridians are more optimistic. So the optimistic view here is that, yeah, we return. But the bond market is a pessimistic view. What is the new danger zone? But for now, we're going to take a look at some of the stocks moving under the hood. We're going to bring in Bloomberg's Isabelle Lee. Optimism in Coinbase today.
A lot of optimism. Shares are edging higher by almost 16%. So the company is finally going to be added to the S&P 500. I say finally because I covered the quarterly rebalance, and I've written around 3 templates on this for every quarter, because we've been hearing some industry chatter that they have qualified for some time, and we have multiple proponents, Michael Saylor, Kathy Wood, congratulating Brian Armstrong.
And he made it there before MicroStrategy, or now Strategy, too.
Yeah.
Strategy is just in the NASDAQ, so they have yet to make it to the S&P. I think what they lack is a profitability requirement. But I saw your tweet, and you said that Brian Armstrong makes the point that they will be added to the multiple retirement plans of people. Basically, if you own an S&P, you will have crypto exposure, and that's really what the crypto faithfuls are cheering on.
Right. Well, you already had it, right, with Tesla, which also owns crypto, and many other companies that have it in their treasury. OnCloud is, I haven't worn tennis shoes outside of the tennis court in like 2 decades, but I guess this is a thing, right?
Yeah.
People wear these non-Nike shoes.
Katie does Hoka's, I do OnCloud.
I would do New Balance probably if I were wearing, or Adidas, but this is like a newfangled Roger Federer
symbol. Yes,
thing.
actually, I bought mine in France because the On stores here always have a line outside, and I'll just never line up for sneakers. But the company actually is rising up at almost 3%. They really raised their sales forecast growth to 28% for 2025. So it's interesting. You see this demand even amid all this uncertainty. So the company is backed by Roger Federer, arguably one of the most famous tennis player, and it's really been one of the top performing sneakers all over the world, eating into the share of Nike and of all your favorite brands, including Puma. We have Stifel calling this impressive. Truist said revenue handily beat, so momentum is really across the board.
Now, Microsoft as well. Let's take a look at it, because Bloomberg can now also confirm that there is going to be planned reductions across the company that will amount to less than 3% of the total headcount, but it's thousands of people.
Thousands of people. That's why you see shares edging lower by 0.5%. It flipped into negative territory when the news broke. So the planned reductions cuts across all levels and geography. It's interesting because software stocks have really emerged as the safe haven for investors seeking refuge. We have the likes of Microsoft and ServiceNow that continues to deliver robust growth despite all the tariff system. We have the software sector even outperforming the tech sector this year. We have an index of software companies up almost 5%, and that's compared to the NASDAQ 100. So we'll see more development from this Microsoft story, but it's interesting because they're cutting jobs.
What shoes do you wear, Isabelle? Are you running around in sneakers? Are
Just
you only
sneakers.
wearing heels?
Oh, I'm wearing sneakers right now. Stan Smith.
Shanali
cool,
typically only wears cowboy boots.
That's
she
wow.
has bought out the boot barn.
No,
I do have.
I'm all about comfort because my feet is messed up. Too much information.
That is a lot for public television. We're internationally broadcast as well as on YouTube.com. Isabelle Lee, thanks very much for that. Coming up, more on the Republicans' sweeping tax plan. We'll head to Washington, D.C. and talk with our very own Kailey Leinz next, co-anchor of Balance of Power. This is Bloomberg Open Interest. Republicans in the House yesterday released a draft of their one big, beautiful bill that some in the so-called SALT caucus are already declaring dead on arrival. That's because the legislation still includes a cap on the state and local tax deduction that had been unlimited for over a century before President Trump drastically reduced it in 2017. Here's the Republican from New York, Mike Lawler, on Balance of Power.
This bill, as written, with a $30,000 cap for those making under $400,000, is just woefully inadequate. And so, no, this does not have my support. It will not have my support. And if this bill comes to the floor for a vote, I will vote no.
We are now joined by Kailey Leinz, co-anchor of Balance of Power, my favorite television show on Bloomberg. Kailey, what are you hearing now about the SALT deduction cap that President Trump promised to get rid of on the campaign trail last year?
Well, Matt, there is still room for this to change. The Ways and Means Committee, which is the key House committee that is in charge of making this tax legislation, is going to be marking up this draft bill at 2:30 this afternoon. And there is room to maneuver here for the SALT caucus. The Ways and Means Committee was given $4.5 trillion essentially of leeway in lost revenue. And according to the Joint Committee on Taxation, this draft bill would only lose $3.7 trillion over the next 10 years. So there is some wiggle room on the margins to do things like increase the SALT cap if that's what it takes to actually secure the votes in the House, where there is a very narrow Republican majority, to actually get this bill across the finish line. Because it's not just Mike Lawler, who I spoke to on Balance of Power last night. His fellow New York Congressman Nick LaLota also said he is a, quote, hell no on this bill. We have questions around other New Yorkers like Representative Elise Stefanik, California representatives like Young Kim, who have called for a higher SALT cap than this. And they do have a good deal of leverage here, not only because the majority is so narrow, but also because if the 2017 tax cuts are allowed to expire at the end of the year, to your point that you make frequently, Matt, there is no cap on SALT. And that actually is something that would work a lot better for a lot of their constituents. So they are going to be loud, vocal voices in this conversation, keeping in mind that there are other areas in which Republicans are at risk of losing votes for this overall package as well, including when it comes to Medicaid cuts. That is in the Energy and Commerce Committee. It will be marked up at 2 p.m. Eastern time. And according to the Congressional Budget Office, the changes they are looking at, which would save more than $880 billion as was required in the budget blueprint, would mean 13.7 million people get kicked off Medicaid rolls over the next decade. And that's hard for a lot of moderates to swallow. And you have problems with conservatives as well, who actually don't think these cuts go deep enough. All of it adds up to a very difficult math problem if you're the Speaker of the House trying to make sure that you actually have enough members of the House of Representatives to get this thing across the finish line, which he wants to do by Memorial.
I think that the Medicare and Medicaid cuts are a little underappreciated, in that we were talking to Wendy Schiller over at Brown a little earlier. She makes a point here that the states will have to take on a lot of these social services. That's when citizens might feel the pain of it. Now, how does that play out in the midterms, Kailey?
Well, that is what Republicans have to consider here. The very members we're talking about, a lot of these SALT caucus members or the more moderates, are the ones that make or break the Republican majority. And so they are the ones that have to consider their constituencies and how they may be negatively impacted by this legislation and what that means for their reelection efforts in 2026, knowing it only takes Democrats right now 4 seats to be able to flip the House. And that is really the difficult line that the Speaker has to walk, keeping in mind that there are many different elements of the Republican conference that he has to cater to, and knowing that President Trump himself has said he doesn't want to see eligible people kicked off of Medicaid. The president is a factor here as well. Granted, he can make phone calls, twist some arms to try to whip the votes ultimately on this package, because it does include a lot of things he wants to see, including no tax on tips or overtime until 2028, expanded tax breaks for seniors, no taxes on interest or deductions on interest for auto loans, all things that he has promised. So there is a lot that he wants to make sure gets done. But of course, there is a great concern about retaining the majorities in both chambers of Congress, frankly, when all is said and done as well.
Kailey, thanks very much. Kailey Leinz, their anchor of Balance of Power. That show starts on Bloomberg Television at 1 p.m. and then the late edition at 5 p.m. Thanks for joining us early. Speaking of the chair of the Republican Conference, Representative Lisa McClain of Michigan. That's today at 5:30 p.m. on Balance of Power. Let's get back to Riyadh, where Elon Musk is speaking at the Saudi-U.S. Investment Forum.
The Boring Company. I have this company called The Boring Company, which sounds kind of boring, but it literally bores tunnels. And actually, tunnels, in order to solve traffic, you really need to go 3D with roads. And by using tunnels, you can essentially create like a wormhole, like a warp tunnel from one part of a city to another and alleviate traffic. And we've actually already done this proof of concept in Vegas. So there are working tunnels in Las Vegas that you can use where that'll just, it feels like teleporting from one part of Vegas to another. So I always say that, my joke is like tunnels are underappreciated. It's a bit of a, not always a hit, but. Yeah, and then XAI is just trying to solve general purpose artificial intelligence. The goal with XAI is to have a maximally truth-seeking AI. And it's important to be maximally truth-seeking AI in order to understand the universe. Mm-hmm. So the goal of XAI is understand the universe, to understand what is out there, where's the universe going, where did it come from, what questions. In fact, I think maybe the biggest thing is what questions do we not know to ask? Like, once you know the question, the answer is usually the easy part. So the goal of XAI is to help understand the universe and yeah, that's the goal. And help people answer any questions along the way, of course. But I mean, that's my philosophy. My philosophy is one of curiosity, just trying to understand the nature of reality.
So I know you had a long day, but we also have the Honorable President and His Royal Highness Saidi hitting the stage soon. Yes. So this is a historic day, a partnership about how we could join hands together, as we have joined hands in the past 92 years, on building a factor-based economy to help the world and power up 20% of the energy mix, which is very critical today to the AI intelligence age, the digital age, and how we have reformed, and with the intelligent age. And we could not be more appreciative of having a lifetime partner and a friend like you, Elon, to the kingdom.
Thank you.
Joining hands on XAI, Starlink, and robotics and Tesla. Thank you so much on behalf of the whole kingdom. And we look forward to continue the partnership. Thank you.
All right. Thanks, everyone.
Thank you. Thank you. Please.
All right.
Was Elon Musk saying he'd like to bring robo-taxis to Saudi Arabia. We're bringing you all of the news from the Saudi-U.S. Investment Forum. Most of it so far has been surrounding the President of the United States of America signing a deal with Crown Prince Mohammed bin Salman, in which the Saudis pledged to invest $600 billion in the U.S. economy.
But Joumanna Bercetche, our reporter out of the Middle East, has made, or correspondent and anchor, has made a great point that this sum was partly discussed before. The details are what are stunning. The other thing I would say, Matt, that is stunning about this announcement is not only the sheer dollars, but the understanding between politicians, chieftains of business, Elon Musk, recognizing that the infrastructure spend is some of the biggest dollars needed, from AI to defense, and Elon Musk really making a big pitch for his own boring company there as well.
Yeah, really interesting that they go from being, we count on them for oil, which is why we invest in their defense, and now we count on them for financing because they are the marginal lender of last resort. I want to just get back to markets very quickly before we end this program, because as you pointed out, we're now positive for the year on the S&P 500 with a level of 58.86. That's a gain of 0.75% after the 3.25% rally that we saw yesterday. So just powering back after this U.S.-China agreement over the weekend. The NASDAQ back in a bull market, up 1.5% at 21,168. And the small caps, we keep showing these small cap. I mean, I would like to show the Dow Jones Industrial Average. It's still down for the year, and it's off today 174 points at 42,236. Also, bonds, right?
Bonds are really interesting, but to your point here, the Dow Jones still negative on the year. Russell still down 5%. The question is, do the dip buyers come in now? And will the bond market get in the way? You're looking at a 10-year yield that has been flirting with 4.5%. Let's see where it goes, Matt.
This is Bloomberg Open Interest.